Hopefully you can see from some of the various panels and discussions and breakouts and individual conversations that you've been having, we've been thinking a lot about how to help the organizations within the community as well as our industry develop high-quality credit products that blend consumer success and provider success. Of course, this is not a new challenge. It's something that we have been wrestling with for a few thousand years now, how to create the appropriate balance between morality, economic interests, and social justice when we think about how to regulate and develop and have well-performing credit products. And if we, as an industry and as a society, recognize that business is one of, if not the most influential enabler of social change in this country, then we have to think about finding high-quality business models to power that change. And we seem to be poised on, if not smack in the middle of, a really interesting opportunity, a really interesting moment in time to make great strides in this area about how we deliver credit, how we deliver liquidity to consumers in a really high value way. There's this witch's stew of things that are happening, including a continued, almost daily emergence of new technology-enabled capabilities and computing power, the abundance of information flowing to everyone involved, the consumer, the lender, other people involved around the edge of the transaction. We have some hard-earned, hard-learned lessons about consumer protection. And we have a really interesting rising set of expectations, of course, from consumers about the businesses that they deal with. We have an interesting set of panelists here with us today that I think are really on the vanguard of this change, and I'm really looking forward to hearing about their perspectives and experiences in this. We have with us three folks. We have Aaron Klein on the end, Director of the Financial Regulatory Reform Initiative at the Bipartisan Policy Center, a Washington-based organization covering a variety of different issue areas, combining politically balanced policymaking with strong proactive advocacy and outreach. We have Louis Barrell, CEO and co-founder of Earnest, a full-stack startup providing both personal lending and student lending as a first step, just a first step, in development of a modern bank for the next generation. And we have Steve Alaka, Vice President and General Manager of Credit at PayPal. Obviously, PayPal is one of the most important, innovative, and influential companies at the forefront of the digital payments revolution. So thank you, gentlemen, for being here, and look forward to our discussion. Something more comfortable now. I really want to start with a high-level question, really, to get us started. What do you see as some of the key pain points that consumers face in consumer lending? Steve, I'll start with you.
So I'd start by acknowledging there are many. And I say this not in a way that's casting stones. I was very much, as a banker, part of traditional lending, and still, to some extent, am, even with what we're doing with credit globally at PayPal today. I think that there's not many examples of customer experiences with credit today that Steve Jobs would get up on stage and talk about beautiful, magical experiences that improve customers' lives. But I think that's something that we should aspire to. I think that the biggest pain point, bar none, is the overly complex, confusing, impersonal nature of the way that credit is presented to consumers and small businesses today. I think that nothing else compares to that, and it pales in comparison to everything else. It actually kills me that I heard yesterday, what I thought was a good characterization, that credit is almost viewed as a scourge in this country and in other certainly developed credit economies around the world. I think that's true. I think that consumers and business owners fear credit. It's been demonized even. And it doesn't need to be something that's feared. It is for good reason, because I think that credit providers have spent centuries making it more confusing and more complex than it needs to be, and making it very impersonal, almost inhumane. But at the end of the day, I truly believe that credit is one of the great enabling tools in the history of the world. People laugh at me when I say that, but I put it right up there with the wheel and the motorized transportation and the airplane and antibiotics as things that have really changed the world. And the big difference is with all of those things, those enabling tools that have changed the world, they got over a mass adoption curve where the masses got over their fear. Think about the fear of getting on an airplane for the first time. The masses got over that fear and then came to confidently be able to use those great enabling tools. With credit, even though a lot of us use credit, most of us don't use credit in a way that we're really confident where we're using credit to more effectively manage our money and become more financially healthy. I think that's because it's overly confusing, it's complex, and we doubt the intention and the motivations of the people who are on the other side granting us that credit. That's what we've got to change. And frankly, the reason that I'm at PayPal, I've been at great banks in the past and great traditional lenders in the past, and I have a startup right here based in Austin, not a startup anymore, that provides data and analytics and risk management to some of the top banks and investment companies in the world. The reason I'm at PayPal is because I think that PayPal's got a unique blend of, because we're not a bank, we've got a trusted brand that's not a bank brand, and we're not anchored down by a bunch of bricks and mortar. We're a technology company. The combination of those things and our mission to help customers more effectively manage and move their money pretty uniquely positions us to be able to tackle this, what I think is just an enormous problem.
Terrific. Lewis, any thoughts on this?
Yeah. So I'm Lewis Pearl, I'm the CEO of Earnest, thank you. We're a technology-enabled personal lender, student lender. Those are the products that we're focused on today. I think that what is missing today is really centered around three things. It's access to credit, it's the cost of that credit, and then it's the experience with the credit. So if you think about those things, and these are the things that we are focused on in our product, right? Well, you have to be able to approve more people. Our product is very focused on young professionals. There's the way we underwrite and approve loans in our product is we use our technology to look throughout their whole lives. We're looking at all of the financial accounts, whether or not they're saving in their 401ks, are they overdrafting their bank accounts or not, paying their bills on time, in a much more extensive way than has really ever been done before. That actually helps us solve both the approval and the cost problem. One of the reasons that credit, I think, is demonized, at least in my own mind, is if you're going to get a 14% student loan or a 20 to 30% credit card, that feels pretty expensive, especially when you feel personally very, very low risk. And then I think the third point that a lot of us sometimes in the industry can forget is that approval or access point very often is maybe it's a week, maybe it's a day, maybe it's a month. The experience of the credit is going to happen over decades. Things like, in our student loan product. Hello? Oh, I'm sorry. So like in our student loan product, the average loan is going to be 10 years. And we're going to, so someone who is, if you think about a young professional in any career, their budgeting is going to be much lower in the first months, years of their lives than it's going to be 10 years from now. So the ability to accelerate your payments, change how the loan fits your life over time is really important to people. And loans and credit have never really been developed in this dynamic way. So we think that's actually a really important part of it.
Terrific. So Aaron, you come at this from a pretty different angle from the rest of us.
Yeah.
Curious about your point.
So let me kind of be similar and different to what Steve and Lewis said. The first point, I guess I break it down in kind of the pain point question into two high-level issues. One is, are we talking about the allocation of credit, the decision whether or not to make credit and upon which terms those are made, as one set of pain points? The second set of pain points have to do with servicing that credit, making the customer experience. We've seen the two are totally related, right? I always think of the subprime mortgage debacle in servicing as being like Lucy and Ethel in the chocolate factory, right? And once, if you can't service it, the whole system will go haywire. I think a lot of the companies and presentations I've heard are focused on improving one aspect or the other, sometimes both, because the two are interrelated, but there is a real conceptual difference. And individuals have different problems to address in both of those. I don't think credit is demonized. I think that everybody understands, most people understand the necessity of credit, just like most people understand the necessity of government, but they often think it can be better for them. It can work better for them. I think in response to the financial crisis, much like in response to the Great Depression, when there was too much credit extended on terms that didn't make sense for either the borrower or the lender, in a system in which servicing became an unmitigated disaster, there's an understandable backlash and weariness when you have to re-enter the system. Because once you enter the credit system, you never leave. And that's fine. And I think it's fascinating to have Louis here because for many people, their first entry into the credit system is that student loan, which for many folks will be their largest debt encumbrance, bigger than a car. It's starting to approach being bigger than some first houses.
Yeah, I like to say it's the home loan of our generation.
Yeah. Unfortunately, you're not necessarily levered 5 or 10 to 1 to get that kind of appreciation.
It's like infinite leverage.
Yeah.
Terrific. We used some interesting words in that conversation. Inhumane, that's a new one for me. Impersonal, fear-based. If we, as an industry, sort of think of ourselves on the cusp of something different, something evolved beyond those types of things, we have the technical capabilities, we have the orientation toward the customer that's required. What do we think? What do you think as companies? What do you think as an industry? We, as a country, we have to do to really address these pain points? What do we have to do to get it right? Louis?
Yeah, I mean, we really went back to first principles when we started Earnest. You know, there's things that everyone here could say about transparency and trust, but we have other principles that we hold very dear and we think drive us to different places than other financial institutions. So, you know, one of our core principles is it's not about what the customer would pay, it's about what the customer should pay. And I'll explain how that translates into our product. I was talking about loans changing over time a second ago. So, does this still work? Okay.
Still work.
So one of the things that we do that's very different that came out of this principle is when someone has a student loan that's a typical student loan would be 5 to 20 years. And if you go to almost any company in the world, it would be like they would give you some choices. It would be like you can have a 5-year loan, a 10-year loan, a 15-year loan, or a 20-year loan. And what we did was, well, we said, well, maybe people, you know, if you pick a 10-year loan, that might be like $520.98 a month monthly payment. And if you pick a 5-year loan, that's $909.72. And the interest rates increase with the term. But like, no one actually budgets $520.98. They budget $500 or they budget $600. And they might not be able to pay $909 because it doesn't fit their budget. So they're bucketed into this higher interest rate group. Well, we said, well, why don't we try to figure out exactly what they can pay? They can choose however much they want. So if it's $700 a month that they want to pay, we let them choose that. But then what our principal said was, what we figured out was $700 a month isn't a 10-year loan. That's like a 7-year and 2-month loan. And then our principle of, well, it's not about what they would pay, it's about what they should pay, said, well, if it's a 7-year and 2-month loan, it should be the 7-year and 2-month interest rate. It shouldn't be the 10-year interest rate. We should approve them on an interest rate curve. And so it's things like that that seem very intuitive and very logical when we explain them, but that no one else has really done before. And that's what really creates trust. That's what really the customers that we believe people really want to see. And you know what the bottom line is? It gets people out of debt faster. They pay less interest.
Steve, what do we have to do to get it right?
I love innovations like what Louis just explained. I mean, I think that's a key part of it. To me, credit is fundamentally about risk. It's about your ability to be able to assess and manage risk. That's going to be the principal driver in who you can approve for a credit product and the price that you need to charge for that credit product over time. And I think that today we're far too dependent upon this 3-digit score that nobody understands, much less can manage. And I know there's many people in the room who are principally involved in that score, and I think it's been great for what it is. But if our mission is to personalize something that is by definition impersonal today, we should be able to create a bridge for consumers between getting more financially healthy and getting more access to credit on better terms, and the connection between those two things so that they know how to use that credit in ways that actually make them more financially healthy. And it might be, well, by refinancing higher interest rate student loan debt for lower interest rate student loan debt, which is a huge societal problem in this country. But the way to be able to make stepwise rather than incremental change there, it's got to start with an ability to fundamentally think differently about how we assess risk. I think that's the major foundational capability.
I know you have some thoughts on this.
Yeah, so look, I think one of the paths to success is innovation and technology. And I think that there's we have a set of regulatory burdens and structures for a very different world. We just finished up cleaning when I worked on Dodd-Frank, the regulatory differences between banks and thrifts. There's not a person alive my age who knows what the difference between a bank and a thrift is. Some people in the room may, but that's going away. At some point, we're going to go away between the distinction between a bank and a financial technology firm, right? When I use PayPal to send money to a friend of mine, it isn't a bank, and there's one regulatory structure if I use my PayPal account, but if I use it through a credit card, I've now interacted, or a debit card, I've now interacted in a different regulatory framework. From the consumer experience, that's confusing, complexing, probably don't understand the distinction, and we have a regulatory structure. In some ways, that structure is probably retarding useful innovation. On the other hand, you do have to be careful when you allow the banking system access to new products and new ways of evolving credit, that things don't run off the rails. And managing that tension is going to be very challenging, and doing so in a way that doesn't retard growth. I mean, I thought the last presentation was perfect analogy about batching emails. I mean, it is nuts how slow our payment system is today. We can fix that in a way that creates tremendous value for people if the government can get beyond its own kind of entrenched positions and embrace technological change as opposed to fear it.
It's terrific. It's a really interesting conversation. It's a really interesting point. It sits well with me. I listened to sort of the way that we had some of our preparatory calls and thought about, if you were designing a product, I go read the rules. How do I build one? It sounds like, Louis, is this where you started? Probably not.
No, so the way we started was, when I was in graduate school, I had worked for about 6 years before that, and I had saved money in my retirement and non-retirement accounts. I had paid all my bills on time. Then I went to graduate school, and I got denied for student loans, and that was a real wake-up call for me. And what I realized there was that there was a big information asymmetry problem, that I felt incredibly low risk, but the lender didn't understand how low risk I was. What I ended up doing was I called my mom. She refinanced her house. Me and my mom didn't have an information asymmetry problem. And
she probably didn't have a servicing or collection problem either.
Servicing actually was the biggest challenge. So when we decided to start Earnest, it was really like, okay, if I'm gonna sit down across the table from you and I'm gonna try to understand your risk and can you afford a loan, what would be the questions I would ask you? And these were really fundamental, really common sense things. What does your cash flow look like? Where does that cash flow come from? What is your income? What is your employer? What do your expenses look like? Have you been saving money in the past? Have you been saving it in retirement or non-retirement accounts? So how liquid is it? If you are borrowing on a credit card, are you paying it off in full? Or are you revolving? Are those interest rates changing? Are you, paying late fees and overdraft fees or not? But your traditional, credit bureaus aren't looking at this data. They're not looking at, your Vanguard, E-Trade, Betterment, Fidelity accounts. But actually, all of these accounts are online. All of the data is out there. And so our clients, in the same way that you would provide bank statements to a bank in a home loan process, our clients can provide documentation to us electronically in real time, instantaneously, of their financial responsibility. And so that's what we look at. And that's how we approve people. And ultimately, it dramatically lowers our costs, both in terms of fraud, losses, approving loans, and we're able to just give people a much better experience and a much better product. So that's how we started.
That's interesting. You know, all of the data is out there. Certainly in our experience, there's a whole bunch of people for which all the data is not out there. How does your platform start to extend beyond, you know, the consumer segments that you're focused on now? How do you feel that happens?
Yeah, so that's a really good question. The mission at Earnest is better access to credit to millions of people at earlier ages and at cheaper prices. And I think you bring up a really good point that we get a lot is, so Earnest works really well if you have some data in the system. It turns out that a lot of people do have data in the system. I mean, we have 40 million Americans and $1.3 trillion of student loan debt. I mean, every student out there has actually some data. They're getting into the system pretty early. But you're right, one of the things that we're working on as we expand, both within the United States and globally, is to think about these questions of, how do we get better and better at assessing people with limited data sets? And hopefully our learnings translate as we grow.
So Steve, you are sort of acquiring customers, servicing customers in a pretty different way. A merchant servicing organization, a consumer payments organization. What do you think of what Louis says there?
Well, I've lived through this whole spectrum, and history. The reality is, history hasn't been kind to smaller scale players who have a new model. That's just the reality of it. Most of those models through a credit cycle have blown up. So I think when I said earlier that one of the reasons why I'm at PayPal rather than day to day, still just focused on the company that I started here in Austin, is that I think you need a certain amount of scale in this day and age. When we talk about modeling capability, I mean, I've got access to dozens and dozens of data scientists and ex-Mossad agents in Tel Aviv and around the world. I mean, there's a level of resource there that I think acts as a natural hedge against that very real historical risk of thinking that you figured out a better way to be able to assess credit risk that historically is often debunked in a credit cycle. So I think everybody who's focused on the opportunity in this space is focused on the opportunity, I think, for exactly the right reason and articulates the opportunity brilliantly. The real challenge over time, in my experience, personally and through observation, is that it's going to take something pretty special. A lot of the talk is going to get weeded out over time. When we enter into a more difficult credit environment.
Interesting. I want to touch on one point that you made, Aaron. You talked about, and Louis backed it up, this difference between a lot of the conversation that we've had within the network, the community at CFSI has been about sort of expanding access, right? How do we score and underwrite and bring more people into or at lower cost? But I thought one of the really interesting points I heard you talk about was the life cycle of this customer in that product. The servicing side is actually maybe not that sexy, but is pretty darn important, and there's some opportunities for improved financial health if you invest in that part of the equation. It's not something we talk a lot about here. It sounds like it's pretty important to the way that you all are approaching this problem. Any expansion on that?
Yeah, I mean, when you think about the technological interface of smartphones, online, whatever the mechanism is, it allows for servicing to be done far more personally, quickly, cheaply, economies of scale at the consumer's convenience. I mean, I pay most of my bills when the world's asleep. But the world being defined as my two small kids. Before you couldn't call, you couldn't walk in and deposit a check, or maybe if you put things in the mail, it would take a while. This servicing structure, I think, has tremendous value, and the question becomes, how does financial technology reorient that process. And then in the servicing side, you're getting all this data and information that then, if it's divorced from the lender, can be resold and repackaged to other potential providers, or it can be incorporated in a vertical integration chain where you see people who are easier to service. If lenders knew who was easy and hard to service, forget about who would default or not, but who would just pay on time with no prompts, no questions, and who would kind of struggle and call up customer service and ask for all these things, you would change a different pricing structure. And the question I think over time becomes, is financial technology going to be able to predict that distinction? And then is that how our lenders going to reprice that information in? And what are the implications of that in terms of unfair, deceptive? How does that play in terms of equal protection? It's been told to me, and maybe you guys know this better than I, that Mac users are better credit risks than non-Mac users, all else being equal. Mac users, right?
That's true.
So Mac users also skew white. I don't think anybody thinks that Apple is a racist company or is, targeting or ignoring one market segment, but it's a fact. So does that have a ratio? If you were to use that in your pricing, how does that respond to your fair lending questions? These are tough questions.
Yeah, I'd like to talk about that. So I think that specific thing, Mac users versus non-Mac users, et cetera, we have to remember is that is correlative to someone's ability to repay, someone's financial responsibility. So you have to ask yourself, like, what is the causal thing that Mac versus non-Mac correlates to, right? And it's probably income, right? So why don't we actually get at income? Why don't we actually get at cash flows? Because if you get at those things, you don't need to look at whether or not someone is going to Starbucks or not to approve credit. And I think that we're really trying to get to the root cause. And so anyway, that's I think that's where the future is headed. I think there was something else there that I want to talk about with servicing. What I kind of see this shift in terms of servicing a little bit like the shift from Barnes and Noble, which we were just talking about in the last presentation, to Amazon. As we develop better, more cost-effective systems using smartphones, using technology, we're going to dramatically lower the cost to serve millions of people at scale. And that cost is going to translate, that savings is going to translate into lower prices for people. And that's a good thing because we don't have to charge people as high interest rates and they will get out of debt faster. That will expand the pie for everyone, improve financial access. The purpose of a bank or any financial institution is to help people realize their hopes and dreams. It's to help people get educated, to help people buy homes. It's not to charge servicing fees. So, yeah.
So what you said is a profound macroeconomic consequence, right? What you said says that technology is going to lower the real natural rate of interest. That's going to change monetary policy. That's going to change fiscal policy. That's going to have a major distinction between people who priced longer-term debt and the new reality. And we should think about this at some point, whether it's this year or early next year, we're going to actually have interest. Federal Reserve is going to leave zero, and things are going to change. And what you're saying, if accurate, is a fundamental change to a lot of models in equilibria who aren't thinking about the very factors that you're describing.
Yeah, I think that's right, and it's particularly right if the banks themselves shift the model and get to technology, because the reality is that a lot of the non-banks, the money that they save in not having brick and mortar cost by leveraging technology to provide origination through servicing more effectively, they're going to more than spend that in cost to acquire new accounts, because they got to go out and they got to go through lead generation sources, and they got to spend a lot of money because they don't have a brand, they don't have a big customer base to acquire accounts. So the way to really change the world is to be able to start with a big base of customers that's who you're already talking to them. So you don't need to go spend a fortune to go attract them, convince them who you are and go attract them, and then leverage technology. Right? So I'm talking about, obviously you can get to why I'm so enamored with the opportunity at PayPal, but also it's the banks have the same thing. If the banks can figure out a way to be able to change the cost structure, to be able to better leverage technology, then they don't have that big acquisition cost. They got huge customer bases.
Yeah, buckle up everybody. We're gonna have a 3-hour panel because we got a lot of stuff to talk about, but we're out of time. Please join me. Say thanks everybody. I really appreciate the conversation.